To get to the core of what's going on, setting the scene, we went from the longest bull market in history to a bear market. Stocks were trading more than 20% from their peaks in just a matter of weeks. And the story isn't just how far we've fallen, it's how quickly. So what do you make of this historic velocity?
Yeah, it's been absolutely breathtaking. If you think about the drawdown from a peak to a bear market, it's the fastest on record. It took us 21 days to get here. The next closest time frame to hitting a bear market was 42 days back in September of 1929, heading into the Great Depression. So we are here on historic times. And in fact, if you look at the market, you've seen 4% moves up or down for 7 consecutive days. It's likely going to be 8 given the market action that we're seeing today. And it's important to actually stay centered, but I do believe that we're getting closer to a bottom, because if you look at the last number of recessions that we've had going back to the 1940s, from peak to trough, the market's lost 32% on average. And right now, as we speak today, we're right at that 32% level. But until we get some more visibility on the path of the virus, I think there's going to be some more choppiness ahead.
The world will return to normal. It's just a matter of when.
Well, I think you got to see peaking out of the cases here in the U.S. Right now, we're just getting started to test individuals, so we don't even know how widespread it is at the given moment. You know, I like to call patient zero, came back from Wuhan in the state of Washington on January 14th. Got checked into the hospital on January 17th. I mean, it wasn't even on the U.S.'s radar, let alone the Chinese radar at that given point. So I think the virus has spread a little bit further than what we think. But once we can get a handle on testing, we can get these infected individuals, we could get them care that they need, and we can get a handle of the number of cases that are moving higher and it's starting to move lower. I think that's when you'll start to see some normalcy set back in. But the key is, if you don't have a vaccine for the coronavirus, I think people, when we get back to our normal lives, we may be reluctant to go to that baseball game or that concert until you get a little bit more visibility on a potential cure.
Yeah, how are you, Jeff, staying focused on the long term as well and trying not to shift off the road?
Yeah, well, I mean, we're trying to focus on signs of bottoming. I mean, I think a lot of the velocity of the sell-off that you've seen here recently is a function of two things. First, equities were overvalued coming into this downturn. The markets had clearly priced in a soft landing, that earnings growth was going to return to 10% in 2020. Obviously, now there's recession fears out there and valuations need to come down very dramatically, but also systematic investors have been selling at a very robust pace. Think about risk parity funds, CTAs, and when correlations go to 1, these funds are forced to delever and delever very quickly. More importantly, though, if you look at the mutual fund investor or ETF flows have been flat over the last month, and you've seen about 30 to 40 billion come out of mutual funds, which is not very robust. So what we're looking for is to flows and the delevering to stop out of those systematic investors, but also to see the mutual fund flows become a little bit more negative, which will be signs of a potential bottom.
Yeah, and while we're discussing the current market environment, I do want to talk a little bit about the VIX as well as correlations. What are you making of the current correlations? Certainly heading towards 1, as you said.
Yeah, heading towards 1, that's where you're seeing all sorts of distortions in fixed income markets. Again, I think that's a key reason why you've seen such a robust and a quick sell-off compared to history as well. Because if you think about risk parity, for example, risk parity funds, on one side they buy equities, on the other side they lever up bonds with the assumption that if your equities sell off, your bonds will be able to save you. But if both are selling off at the same time, these types of players are forced to liquidate in a very aggressive manner. So I think higher volatility is likely to be with us in the near term. If you see some signs of, again, the incidents peaking out from coronavirus, maybe the market overshoots to the bottom of maybe negative 40, 45%, where it's clearly priced in a very aggressive recession. I think you could see some value buying there, but unfortunately, I think the volatility genie is let out of the bottle.
And I think, too, you bring up a good point with just the amount of selling or gains that we've seen on any given day, above 4%. It's hard to remember what a normal day in the stock market looks like now.
Yeah, as active managers, if you look at where active managers outperform passive indices, it's periods of single-digit returns in the markets where there's high dispersion. That's typically late cycle, end of cycle type of dynamics, but also in these volatile markets where you really can separate the winners from the losers, focus on strong balance sheets, free cash flow generation, low debt, that moat, as Warren Buffett would say, around your business. And obviously, we're in that period right now.
Scary for investors right now, given that we are currently in a bear market. But that being said, we're seeing this spike in the VIX That's also Wall Street's fear index, many people call it. How do you think about the VIX, and how are you watching the VIX?
Well, the VIX is the tail that wags the dog at this point, given that VIX is an investable asset class. You have these levered portfolios that you can buy the VIX with. It may not have as much information value as it once did, but again, it's something that we're watching for. And generally, when you see VIX spikes of this nature, I mean, I think a couple days ago we had the highest VIX spike in the history of markets. It usually represents capitulation, or you're getting close to that point where everybody has sold, and then buyers are left, and it forms a pretty good long-term bottom. So it doesn't mean that markets aren't going to be choppy. It doesn't mean that the markets couldn't move further lower from here, but I think we're rapidly approaching that point where it's a pretty good long-term buy as long as you have a 3 or 5 year time horizon. And one thing I'll say is the market is a forward-looking mechanism and discounting mechanism, if you will. And right now the market is pricing in the obviously slow patch, the recession that's likely to happen here. But it will bottom well before we get out of that recession. So the market usually will start to price in a recovery about 6 months prior to we actually getting out of that particular recession. There's an old adage out there is when the NBER, the official institute that calls recessions, when they actually call a recession, it's usually a pretty good time to buy stocks.
Mm-hmm. And let's talk a little bit about pullbacks versus crashes. I mean, Jeff, what do you think we're experiencing right now?
Yeah, so we would define a market crash as a bear market that lasts longer than a year. And since the 1960s, we've had 6 market crashes in U.S. history. 5 out of 6 of those happened to be recessionary. The only one, ironically, that wasn't a recession was the market crash of 1987, better known as Black Monday, that time frame. But pullbacks, we think of any other large drawdown that's less than a year, so 15% plus drawdown. And when you compare the crashes versus the pullbacks, usually crashes last a lot longer. The drawdowns are more severe. But again, they have that much higher probability of an actual recession. So thinking about where we are today, I think the sell-off that we've seen was so pronounced and so quick. I think we'll likely find a bottom sometime over the next couple of weeks, maybe in the next month. The market will start to price in that recovery as we get to the back half of the year. So I have a hard time to believe that the markets will still be down 20% by this time next year. So in my opinion, it's probably going to be a pullback rather than what our definition of a market crash is.
There certainly are some silver linings through all of this heightened volatility.
Sure. It's all about optionality, right? When you have some cash, you can take away from some of the areas that have held up in that type of downturn and then redeploy it in areas that are more distressed. What we've found is if you're looking for areas to hide out into the equity markets, there's really 3 sectors that have historically done the best. We looked at the last 15% plus drawdowns that we've had, and 3 sectors outperformed on a relative basis, and their hit rate was 100%. That was consumer staples, healthcare, and then also utilities as well. Consumer staples was the best. On average, it outperformed the market by 20% on a relative basis. But again, each and every one of those timeframes, they outperformed. So if you're looking for areas to weather the storm, I think those 3 sectors are going to be the ones that should be high on your list. And Chris, you brought up an interesting point of a risk that I think is going to manifest itself in the coming weeks and months is the fact that investment grade is no longer what our grandfather's investment grade was, right? If you look at the triple B space and investment grade back in 1973, it was about 9% of the index. Over the course of the last 45 years, it's ballooned up to closer to 50% of the index. And you mentioned Kraft Heinz here getting downgraded very recently. They're the 7th largest fallen angel in the history of the high yield market. It was about 1.7% of high yield. And the problem with that situation is you go from a $6 trillion liquid investment grade market to a $1.5 trillion illiquid high yield market. And when you have systematic stress like we're seeing today, it becomes even less liquid than it already was. So my fear is I feel like you're going to see a lot more fallen angels because of the sudden and aggressive stop of economic activity that you're going to see here. And that could cause some distortions in not only fixed income markets, but also the underlying equities of those credits. So valid point. I do think that it's an underestimated risk. It's something we've been talking about for quite some time. Would these companies have taken on a lot of debt, preferred share buybacks, higher dividends? Would that day come home to roost where the economy fell out of bed and they would have a difficult time being able to service that debt? And I think we're going to get a good glimpse on whether or not that's the case in the coming months.
Do you think ETFs are playing a role in terms of the liquidity equation?
Well, I think it depends on what type of ETF you're talking about. If you look at the last 10 years of inflows or outflows, ETFs have seen about $2.5 trillion worth of inflows. which is quite a hefty number. The ironic thing is that the biggest inflows into equity markets have been share buybacks, believe it or not. It's been about $4 trillion. One of the things that I've been watching for is the share buybacks to drop. If you do see companies retrenching from the equity markets, I think you're going to see higher volatility and a much lower share price of the S&P 500. Buybacks have actually held up well considering the volatility that we've seen, so we haven't seen them fully retrench. But at the end of the day, ETFs are now a very much bigger part of the market, and it allows investors to get in and out of positions indiscriminately very quickly. So I think that's one of the things that are bringing this dynamic of faster sell-offs, faster recoveries, and the change of market structure overall is that ETFs are a much larger part of that equation. Think back to the last big sell-off that we saw, which was fourth quarter 2018. It took us 3 months to go down 20%, which is a very fast sell-off in its own right. And then the market shot back up right after Christmas and didn't look back. The previous large sell-off that we had until now. Previous large sell-off was back in February of 2018 with the short vol unwind. It took us 6 days to go down 10%. So similar to today, I think the sell-offs are going to be much quicker because of these new players and these new products that are dominant in the financial market system, which are ETFs. But again, putting the shoe on the other foot, I think the rebounds are going to be quicker as well. So again, it just adds to more volatility at the end of the day.
A lot of energy investors losing a lot of sleep right now, I'm sure, too, with everything with OPEC and Saudi Arabia and Russia.
Well, look, we're not getting, the global addiction to oil is not going to end anytime soon. Now, everybody talks about peak oil demand. Well, you've seen peak oil demand in the developing world for the last 10 years. The developing world had peak oil demand of about 50 million barrels. We're down to 47 million barrels in the developed world. It's really the emerging world that has had this thirst for oil. And if you look at your average individual in developed markets, we consume about 13 barrels of oil per year. The average consumption in the emerging markets is about 3 million barrels. But there's 6 billion people in the emerging markets, and they're going to eventually consume more oil. And that's going to put a lot of pressure to produce more oil over the next 10 or 20 years, even though you have all of these green initiatives that are going to move forward, but it's certainly not going to displace that demand. I don't know if now is the best time to buy energy yet, because because of all of the supply that has been pushed onto the markets because of Russia and OPEC at the given moment. I think you're going to see a lot of bankruptcies, a lot of consolidation, but from the ashes that are going to be born from this situation, I would think that would be a pretty good long-term buy, 5-10 year type of situation. I like that one. You know, Warren Buffett said, when everybody's greedy, be fearful, and when everybody's fearful, be greedy. And nobody is greedy right now in the energy markets.
Yeah, yeah, especially with ROPEC on all of those risks right now. It's not just a demand issue, and building off of your comment about global demand, what are you making in terms of, or what is your global outlook right now?
Yeah, I think we're going to have a global recession. The definition of a global recession is GDP growth going below 2.5%, given the fact that China has gone offline. And we haven't seen the official Chinese GDP print here, but it'll probably be in the 1 or 2% range, the unofficial number. But just doing a back of the envelope type of calculation from the drop of manufacturing PMI that we saw in 2008 versus the drop of PMI that we saw here recently, that would suggest that GDP growth dropped by about 10% in the first quarter for China. So the real number is probably closer to a negative 5% print versus what they'll say officially. Obviously, South Korea shut down, Italy's shutting down, the US is shutting down. So I think a global recession is a foregone conclusion. And more importantly, I think a US recession is a foregone conclusion as well. We've recently upped the probability of a recession on our recession risk dashboard to 75%. And the reason why it's not 90% is it may not fit the technical definition of a recession as most people think of as 2 negative quarters of GDP print. Just a quirky way that the calendars work out right now. So you had a pretty strong January here in the US. February was okay, but obviously March numbers are going to fall off a cliff. So you may still have a positive first quarter print here in the US. I think next quarter's print is going to be something like -5%, -6%. Very, very deep recessionary type of quarter. And then with all the stimulus that's coming out from the Fed and likely on the fiscal side of the ledger, we could have that reacceleration of growth in the third quarter where that could print a positive number. So that's why it's a 75% probability of a recession. But then again, the markets are clearly pricing in a recession at this point. So I don't think it really matters from a market perspective.
But you think it'll be a pretty shallow one. You say, I don't think this is a crash. I think it's more of a pullback.
I do. I do think it's going to be a shallow recession, similar to what we saw back in 1990, for example. It wasn't a very strong recession. 2001, believe it or not, wasn't a very deep recession either. But I think if you look at the average recession that we've had, it's usually around 11 months. I could see this one being clearly like a 6-month type of recession where you have this distortion. It plays out over the course of 5-6 months, and then life gets back to where it was prior to the outbreak of the coronavirus. The one thing that I've been saying, though, is I don't think it'll be a V-shaped recovery. I do believe, as I mentioned, that people won't go back to their normal behaviors until you do have a vaccine for the coronavirus. So I would imagine it's going to be more of a U-shaped recovery rather than a V-shaped recovery that you typically see coming out of these bottoms.
When a lot of people hear the word recession and panic immediately, I wonder, how would you recommend checking your emotions at the door and investing rationally during this time?
A good advisor is worth their weight in gold. I mean, it's easy to sell, but it's much harder to buy back in once you've seen the market crash back down. But there's a good statistic out there that since 1936, even if you were the best market timer in the world and you're able to sell 10 months prior to a market peak and buy back 10 months after the market low, you would have been worse off than someone that just stayed invested the entire time. And that's what the benefit of hindsight. We've run an analysis at ClearBridge, and if you look at every decade since the 1930s, your average price return during that decade was 114%. But if you missed just the 10 best days of the entire decade, so 10 days out of 3,600 days, your return goes from 114% per decade and drops all the way down to 44%. So you would have lost 70% return during each decade if you just weren't invested for the entire time. And I hate to say it, but a lot of the big return days are at the very bottom of a bear market or a recession when you're coming out the other side, or at the very end as the markets get euphoric and you have that blow off top.
Really illustrates your point about staying in the game, putting the fear aside, keeping your money in. And in the same way that, you mentioned a financial advisor is trying to get the client to have that confidence, have that calm, to stay invested. The Fed is trying to do the same in a way. It's okay, we're here, we're stepping in. We've done two.
Very forceful.
Yes. The Fed is really trying to say we're here. What do you make of monetary policy right now and these emergency rate cuts?
Yeah, I think the Fed did absolutely the right move. I mean, it's good to go in aggressive on the front end to try to stem the tide and ease financial conditions rather than play, Monday morning quarterback and try to catch back up. I think it was the right move cutting rates to zero. They brought back a QE program, which surprised market participants, of $700 billion, $500 billion of which is going to be treasuries, $200 billion is going to be mortgage backs. And if you looked at the mortgage back market, it wasn't functioning properly, even though 10-year treasury and 30-year treasury rates have come down dramatically. Mortgage back rates or mortgage rates for the average American have actually been going up during the course of this time. But since the Fed announced that program, you've seen rates start to come back down, which should be a boost for consumers to be able to refinance. They cut the reserve requirement rates to zero. I don't think banks are necessarily going to lend right now because a lot of their lines of credit or their revolvers are being drawn down by corporations like Boeing in the hunt for cash and the fear of what's going to happen. Also, they opened up swap lines with a lot of developed economies, central banks, dollar swap lines to help ease a lot of the dollar funding issues that you're seeing right now. And then just recently, they opened up the credit facility, commercial paper facility to corporations, and also the primary dealer facility as well, which a primary dealer can bring any type of collateral to the Fed basically and get some sort of yield return back on that. So the Fed is bringing back the crisis programs of 2008, and I think that it's a very smart move. It's easy to try to calm financial conditions rather than have financial conditions get out of control and try to play catch up and ease them after it's already happened. So I think the response was good. I think it was very much what the Fed needed to do, and it'll be interesting to see what the financial market reaction is going to be as we get a couple of weeks from this point.
Jeff, any final thoughts on your end?
No, I just say that one thing that we're really looking for is the next fiscal package to come out, the third fiscal package. We think it needs to be a shock and awe type of package, bigger than TARP back in 2008, which was $700 billion. If you break down the U.S. economy and 70% of the U.S. economy is consumer spending, That's about $1 trillion per month in consumer spending that's potentially offline as we move through the coronavirus. So I'm hoping that the fiscal package will be $1 trillion plus. I'm hoping in the 1.2, 1.3 range. I think anything lower than that, I think the market will revolt and eventually bring Congress back together to give the package size that the market would like. But I think when you get some visibility there, I think there's likely going to be, we're getting really close to a bottom at that point, and especially if you combine that with a peaking out of potential incidences here in the U.S. But longer term, the market goes through 10 to 20-year periods where the market goes nowhere, which is a secular bear market, and they're always followed by a 20-year period where the market goes up substantially, which is known as a secular bull market. This dynamic's been going on since the 1930s. And if you go through this period, we're in firm belief that we exited the secular bear market of the 2000s, and we're now in year 11 of a 20-year period where you're going to have outsized equity returns. So I do believe the market are going to have a lot more all-time highs in the upcoming decade. I think aggressive monetary stimulus, fiscal stimulus, and the fact that bonds are so cheap compared to equities right now is what's going to end up fueling the next rise of equities.